Eric Muathe, Muathe.com, for the weekend of January 16th and January 17th, 2016. Take a look at markets here. We are looking at world markets on Friday, closing down pretty much, as we can see here. Biggest mover being in China, which was down about 3%. Take a look at how European markets closed on Friday. And we also show that European markets had a down session, down, let's call it about 2% across the board. Take a look at the Americas here, and we are looking at Brazil down 3% for the day. Canadian market is also down about 2.5%, and the other markets are also down substantially. Argentina is down about 5%. Take a look at the US as of right now, with about 2 hours to go before the close of the week and of the day. We can see that the Dow is down 400 points, NASDAQ is down 3%, S&P 500 is down about 2.5%, and oil is down about 5.7%. So let's take a look at the charts. So this weekend's market analysis video is gonna be a little bit on the easy side. Reason being that if you take a look at most of the markets that you are trading, you'll see that, for example, the Australian market here, trading below 2015 monthly closing lows. That's a fresh break. And so the risk worldwide is at the moment for lower prices, month to month. Because we are looking at monthly charts here, the risk remains month to month. The markets move lower. And pretty much most of the markets are going to be showing the same RSI break to 3-year lows, which is a major sell signal. Also, MACDs moving to fresh 3-year lows on both MACD settings, and the default MACD setting also moving to fresh 3-year lows. So this is a major risk. Keep in mind, if your markets are about to move below 38.2 on the monthly, expect a big down month whenever that takes place. So that's the Australian market. We take a look at the same type analysis here with the South Korean market, the KOSPI. As you can see, without fail, all these markets are moving to fresh monthly lows here, below 2015 monthly closing lows. We can see here that we have both our indicators moving to fresh 3-year lows, as you can see here on the RSI, with a chance of moving below 38.2. So the risk, and it's just risk, we don't know which way the market is gonna go for sure. Nobody really knows unless you're in that dark room. But below 38.2, that would be a major drop to take place. Also, the MACDs are trading at 3-year lows and also moving below zero for the first time in more than 3 years for the KOSPI. The same can be said about the Japanese market here, moving to fresh monthly lows. As long as it is below 2015 monthly closing lows, the risk is month to month lower prices, not day to day, but month to month. We can see here RSI moving to fresh 3-year lows, and here already down for the month about 10%, but because it is moving below RSI 50 this month, it might have an even bigger drop into the end of the month. Take a look at the MACDs, and the MACDs are giving us a classic sell signal, as the MACDs are also moving, or at least one of the MACDs is moving to fresh 3-year lows. Take a look at another market, similar type analysis, Hong Kong. And Hong Kong below right now, moving to fresh monthly lows beyond 2015's monthly closing low. RSI right now gapping to 3-year lows and also moving above or below 38.2, which means the odds, and they're just odds right now, point to an even lower market month to month. You take a look at the MACDs, and the MACDs are also trading at 3-year lows. Let's take a look at another market, South African market, which again is plunging here, moving to fresh 3-year lows, moving its monthly RSI below 50. That's why we are getting this big drop, about 10% for the month so far. Take a look at this break beyond and below 2015's monthly closing low. So once it broke through there, and we've been talking about this the last couple of weeks, once it broke through there, the risk was always to the downside, and that risk is being at the moment realized. Take a look at the MACDs, and the MACDs are exactly where you'd expect a sell signal with the MACDs moving to fresh 3-year lows. The risk continues to be to the downside. Take a look here at the Nigerian market by way of the ETF that trades in the US, NGE. And we've been talking about this being bearish and staying bearish as long as the monthly RSI remains below 30.90. Of course, that has been correct analysis because we've seen continued drop over the last 4 months or so. So this makes sense to be trading at fresh lows because you are trading below that 30.9 RSI level on the monthly. Let's take a look at the next market here, and it is a French market, and we can also see pressing below 2015's monthly closing low gives a fresh break and a reason to be thinking that this might actually even see lower prices. As long as that's the case, we are moving below RSI 50 this month, suggesting a big down month, and we're already seeing that taking place. And we can also see that it is moving to fresh 3-year lows on the monthly RSI, suggesting we should not be too surprised if this continues to get even worse on the downside. Also, MACDs at fresh lows, so no surprise that this is actually taking place with the markets continuing to press lower prices. Take a look at the German market, not to be left behind here. The German market with Friday's move is now below 2015's monthly closing low, so this is a fresh and a timely break for anybody who wants to play the downside. We can also see that we are pressing below 50. We discussed this numerous times. As you press below 50, you get a big plunge, and which is the opposite of when you move above 50, you get a big spike. So right now, since we are pressing below 50 with the risk of moving to fresh RSI lows, which is a fresh sell signal, and the MACDs are also showing resistance the last time they tried to move above 0, with uniform activity rejection at the 0 line on the MACD there, and now with a chance of moving to fresh lows on the monthly MACD. So the risk continues to be to the downside. We take a look at the Indian market by way of the Nifty, and here we are seeing it had already moved to fresh lows, so somewhere around here, fresh lows right there, to fresh lows beyond 2015's monthly closing low. Right now down about 6% for the month, and it makes sense because we've been talking about the fact that if it slips below 50 on its monthly RSI, expect a big down month. And the problem here is that we are also breaking to fresh monthly on a 3-year time frame, so the RSI is at 3-year lows, which is a major sell signal. So we've been talking about this. No surprise that we are trading where we are trading. The MACDs also have looked bearish because the secondary MACD has been close to 3-year lows. So once it moved to fresh 3-year lows a couple of months ago, and now again we see it again moving to fresh MACD lows over the last 3 years and trading below 0, the risk continues to be that this is a market that could easily see much lower prices in the coming months. And in fact, if we let's take a look at a long-term monthly view here. Let's take a look at a long-term monthly view going back to 1990. Just want to show you a couple of observations. There have been a couple of periods when the market was very bearish, or the Nifty was bearish. It's period number 1, 2000 to 2002, 2003, and of course late 2007 to early 2009. Now both periods you can see began with the RSI breaking down below 50. So we can say here, so there was a trend line break there, just like there was a trend line break here, corresponding with both highs, the high in 2000 here and the high in 2007. And now we are seeing that we already broke through another high here, which might be the high now, on hindsight, the high of 2015. So that's some sell signal there. And also the periods when the market was bearish, so this period here corresponds with the market being below 50. This period here corresponds with the market being below 50, and now we are below 50. Not only that, we broke a recent trend line there. So that trend line was connecting the lows of late 2008, early 2009, the lows of 2011, lows of 2012, lows of 2013, and the slight support attempt for late 2015 lows. So we broke through that. In other words, the risk continues to be to the downside. So that's the bearish view. This is the weekly, and we can see that a couple of weeks ago we talked about the fact that the 10-week moving average, because the 10-week moving average was already trading at fresh lows a couple of weeks ago, the speculation was that the price would have to make a fresh 52-week low, which is what we are getting. So whenever you see your 10-week moving average make a fresh low before the price, generally speaking, your prices are also going to have to make fresh lows. But now what we are looking at here is, I want to discuss this, is the fact that if you take a look at a 5-year weekly for the Nifty, there is a slight chance, or at least let me say there's a chance, that this might be where it might stop going down. Maybe, maybe not. There's two lines we can consider. Line number one is off the lows of late 2011, so this entry here in the RSI. So the RSI moved above that range here, and since then the market has gone on to record higher highs. So that was a critical low, late 2011. We can draw a line from here like that, and what this line does is give you all the support levels since 2011. You can see uniform activity support here for the lows of 2012, nice support here for the lows there, support here for the lows here, support here for these lows, and then uniform activity below this line and back above it for the lows there. And then again, over the last couple of weeks, there was some slight support here, not very fruitful, but at least it was support. So if this market can hold up above that green line, there is a chance that it might move higher. So that's something you can watch there for some potential support. Also, if you want to draw a line connecting the lows here on the RSI and extend them, you can see at the close of this past week, week number 2 of 2016, if that holds, that might be enough to start stopping this recent slide. Now remember, if this is to hold, we can also argue that we are seeing an improvement in a short-term RSI while prices are making fresh lows on the weekly. So that might set up for a slight bounce of some sorts. Now you can see that the challenge here is what happens when the market comes back to test the top line. So the key is what happens. It might rally, but if it cannot take out this declining RSI line on the weekly, that might suggest that we are still in a downtrend, even though week to week we can get a couple weeks to the upside. So the risk, or at least the major challenge, is whether the market can move above this declining RSI line. One quick look at the daily, and the daily is going to give a little bit of a slight, idea that maybe we might bounce on from a day-to-day perspective, making lower lows here in the price while RSI is making incremental improvements. So that might be enough to set the stage for a slight bounce. Whether it takes place or not, we shall see. Now the risk is the markets are so broken that maybe they break through the support line. If we break through the support line, and if we move below 30.9, that might suggest lower price. So yes, the weeklies and the dailies do suggest the possibility and the potential for a slight bounce. Otherwise, if they break those support levels, then we might see short-term an even bigger correction. Let's take a look at China, which was down again this past week. But then again, what market wasn't down this past week? Take a look at China here, and we go back to our previous analysis. We were talking about resistance at the 50 level on the weekly time frame right there, and you can see this has become a resistance level. And so our analysis over the last couple of months has been hinged on this resistance level, and we came back here late 2015 and failed. So of course we are seeing what happens when you fail. You're gonna get this movement lower. So that makes sense on a weekly time frame. We take a look at the monthly, and we can see that for the month we are breaking here below 2015 monthly closing lows. We are also pushing below 50, and as long as we are pushing below 50, on a month to month on the RSI, I expect a big down month for now. So still we are seeing the market not look as strong, even though only one of the MACDs is trading at 3-year lows. So yes, one of the MACDs is now breaking down to fresh 3-year lows, RSI moving below 50, but we are not seeing the RSI yet come to test the 3-year low line. So this is, yes, the market is down about 15% for the month, which is huge. And the reason why it's down that much, I would say, is because of this move below RSI 50 level. But whether we're going to get a bounce or not, we shall have to wait and see. On a daily basis, we can conclude here that as long as the RSI on the daily is holding below 30.9, we should not expect a bounce. A bounce will come only after we've moved back above 30.90. As an example, you can see here the last time it was challenging and trading below 30.90, it stayed down until it moved back above it, and that's when we started this slight recovery. So it needs to be above 30.90 is if there's going to be any serious rally attempt. If we take a look at the FTSE, it already broke down to fresh monthly lows, so no surprise that we're getting a big drop this month, down already 7%. And here the risk continues to be to the downside, clearly month to month for now, because we are moving to fresh 3-year lows. Not only that, we are breaking below 38.2, which is a major sell signals, and also your MACDs are breaking down to fresh 3-year lows there, so no surprise. Even though if we take a look at the weekly, I can see how somebody can argue that this is an improvement, because we've been making lower lows, so incremental lower lows here in price, but the RSI has been slightly improving and holding steady over the last couple of weeks. So this might by itself might be a setup that might give us a week-to-week rally within the bigger bearish month-to-month movement. We take a look at the daily here just for color, and on the daily we can also see that yes, the market was down on Friday, but we might be setting up to show some improvement on the RSI. If we can have some positive divergence, maybe day to day we might get some relief rally. Take a look at the hourly, and the hourly is also showing similar type analysis to what is taking place in the US. You can see an improvement here on the hourly chart as markets have been making fresh lows. The RSI has been making higher lows. So if that's the case, this might be a reason to begin the upcoming week with a slight bounce. How much of a bounce we might get, tough to tell. Take a look at the Brazilian market, which has been really under some bearish market environment over the last 2-3 years. And here again, pressing to fresh lows, fresh multi-year lows, also moving below 30.90 this past week, which might explain why it had a big down drop there. And this does not include Friday's drop. If we take a look at the monthly already broke down. Here we see that the monthly chart already gave a sell signal when it moved to fresh 3-year lows, and also when it moved to fresh multi-month lows in December. So there was a sell signal there, and this market has been one to avoid. And now the risk is if it moves, if and when it moves below 30.90, that might suggest an even sharper drop whenever it takes place. So the risk here is that this could continue trading much bearish because it is close to 30.90. On the monthly MACDs, doesn't look good because the MACDs are here right now moving to fresh 3-year lows, which might explain Friday's 3% drop. Take a look at the TSX, the Canadian market, and just like the Brazilian market, this week we are seeing it press below 30.90, and also we can see that there was a fresh weekly break at the beginning part of 2016, so that was another sell signal. Doesn't look good. We take a look at the MACDs and the RSIs on the monthly, and they don't look good at all. So we can see the Canadian market for now had already broken down to fresh 3-year lows. We talked about the risk over the last couple of months that this was a market that was looking like it would drop even further because the risk was there that the MACDs were making a move to fresh 3-year lows. The RSI was about to make another move to fresh 3-year lows, and the risk was that if it moved below 38.2, which is what it's done this month, and actually going back to last month, the risk was if it moves below 38.2, we were gonna see a major drop, and that's exactly what we got. So right now down about 7% for the month, which is consistent with our analysis. Now I want to take a look at the hourly here, because the hourly, just like where I'm going to show you with the S&P 500, there's a slight argument here. We're making lower lows on the hourly, but the RSI keeps making a higher and higher low, yes, over the last week or so. So this is an improving situation. As long as it is bouncing on this blue line on the RSI, we should expect some type of a relief rally to the upside, and we shall see how strong of a move that can be. So I want to conclude here with the SPX. Quick look at the S&P 500, and for the month, so let's go to the monthly here, and for the month we can see SPX moving to fresh monthly lows as of right now, below 2015's monthly closing low. We are moving below 50, which is the reason why we're already down about 8%, because as we move below 50 we get a big move. And here moving to fresh 3-year lows, some major sell signal right there. MACDs are also acting bearish as they move to fresh 3-year lows. So the risk here is that this continues to get worse. That's the risk. Can the market bounce? Yes, it can. How much of a bounce? Who knows? But you have to start somewhere, and we can see for now, we are seeing the market making a slight improvement as we make fresh hourly lows. There's a slight improvement on the RSI on a hour-to-hour basis. So if this holds, maybe we get some type of a relief rally. Otherwise, within the construct of a month-to-month setting, the market still continue to be bearish. Eric Muadid, muadid.com. As always, good luck, peace, and blessings. EACS.